Good evening, everyone, and thanks very much, Eddie, for having the opportunity to talk about our business this evening. So I'm Christian Faes, co-founder of LendInvest, which is a peer-to-peer lending platform for mortgages, and also managing partner of Montello Capital. The broad theme tonight is crowdfunding, and I'm going to put forward the proposition that it represents the potential to be the future of finance. So it offers the true potential to disintermediate the banks and to be one of the most disruptive forces that have come into finance in many decades. Now, obviously that sounds like a fairly bold claim, but I'm certainly not the only one that's making these sorts of claims. So we've got Andy Haldane, who's the Director of Financial Stability at the Bank of England. He's become a bit of a cheerleader for the crowdfunding concept. He's certainly not someone that's got a vested interest in sort of trying to promote crowdfunding. This is a great quote, I think. This is comes from an interview he gave to the Telegraph late last year. And I think, you know, in the interview he talks about technology disintermediating and disrupting industries, like in the music industry with technologies like Spotify and Napster. eBay came in and liberated the publishing industry. And he asked the question, why can't we have an open market for loans? So I think it's great to have him on board. Obviously, it seems that there is government buy-in with a lot of these platforms, but obviously, critically, can we make money from this type of from this concept? So the best place to look to sort of see where the potential for crowdfunding is being achieved, or just being touched upon probably, is over in the United States. So there's a business over there called LendInvest. It's not LendInvest. It's Lending Club. Sorry. Now these guys are absolutely massive. They started in 2006. They've lent over $2.5 billion since setting up. They've been ramping up their lending volumes as time goes on. They're currently on a monthly rate of about 150 to 200 million a month. So, you know, this year they will lend more than they have since they set up in 2006. They've been able to attract absolute superstars of the finance world to their board. They've got Mary Meeker, who's often dubbed the Queen of the Net by the press, the ex-CEO of Morgan Stanley, John Mack, and they've got Lawrence Summers, who's the key economic advisor to President Obama, and tipped to be the next Fed chairman. And in case there was any doubt that this is a serious business, Google recently invested 125 million, which put a valuation on their business over 1.55 billion. So I think the point to make is that, you know, these sorts of people don't sign up to fads. You know, there's a real potential with crowdfunding. And I think it's here to stay. So I'm assuming everyone understands what crowdfunding is and the broad umbrella of crowdfunding. The dictionary definition being the practice of funding a project or a venture by a large number of people contributing small amounts of money, typically through the internet. So the sort of what I wanted to make here, or the point I wanted to make here, was that it's a broad umbrella crowdfunding. So it does include concepts like Kiva, which you know, is a not-for-profit crowdfunding platform, to platforms like Crowdcube and Seedrs in the UK, which are equity crowdfunding platforms, through to lending platforms like we are. So that's the business that I wanted to talk about tonight and introduce, obviously, is LendInvest. So like I say, it's a peer-to-peer platform for mortgage lending. We set up the business in terms of the corporate vehicle about a year ago. I've been working on the background on the platform. We launched in May. Since May, we've traded almost 6.5 million in terms of loans through the platform, and that's sort of growing on a monthly rate. In terms of the background of who we are, so I'm an ex-lawyer, used to practice in the city. Then we set up a business called Montello Capital in 2008. I set that business up with Ian Thomas, who's here tonight as well. He's a chartered surveyor by background, used to work for one of the largest property developers in Europe. And then we've recently brought on David Serafini, who's here as well. He's come on as our managing director, and he's from an IT analyst background with RBS and Credit Suisse. So, as I mentioned, Ian Thomas and I set up Montello in 2008 with another business partner, which is now one of the leading short-term mortgage lenders in the UK. We've focused principally on the London residential market, but we're not a mainstream lender. So we lend typically for loans less than 12 months in duration. So it's sort of a specialty side of the mortgage market. when we came into the market in 2008, we had pretty grand visions and were extremely naive in terms of what it would take to build a finance business in that market. Having said that, 5 years later, I think we're pretty happy with where that business is. It's a very healthy business, it's growing at a healthy rate as well. We've got 2 funds, which are the principal vehicles for funding our loans, the Montello Income Fund and the Montello Development Finance Fund. The Income Fund provides investors with a fixed return of 8.5%, the Development Finance Fund providing investors with a fixed return of 10%. So they've actually become quite popular investment products in the current environment. We started off promoting those funds through IFAs in the UK, and then sort of with regulatory changes and so forth being a bit of an inhibitor, we've branched out and we now have investors throughout Europe, Asia and the Middle East. We've got about 70 million under management, net inflows of a couple of million a month. So that business is growing quite well. One thing I should mention on that principally is we've got a 5-year lending track record. Whilst we do have had defaults, typically less than 5% of our loan book. That's the nature of lending, mortgage lending as well, but we haven't lost a penny of capital in 5 years of lending. So the story to here, I think it's useful to take a little bit of a macro view in terms of some of the forces that I think are coming into play to make crowdfunding such a popular concept. So I think, as I say here, it's the potential for the perfect storm as a result of the credit crisis for a disrupting force like crowdfunding to come into play. We've got a situation where there's a general market sentiment or an anti-bank sentiment within the market. So, the banks aren't lending and we don't trust them. So we know that banks aren't lending. It's pretty much in every newspaper you pick up. The reason they're not lending, they've got bad legacy loan books. They're constrained by increasing capital adequacy requirements with Basel III. They've got regulation changing all the time. So it's quite a difficult environment for banks to be, increasing their lending appetite. In the mortgage market, which is obviously what we operate in 2002 you had 220 billion being lent. These are figures from the Council of Mortgage Lenders. In 2007 there was 362 billion, which was the height of the market, and last year there was about 142 billion. So we're still dramatically less than half of what we were, in the height of the crisis. There have been some government schemes come into place recently, so you've got your funding for lending, the help to buy schemes and things like that. They are starting to have an impact, and certainly the last few months of figures from the Council of Mortgage Lenders have been positive, but at the same time, the important thing to look at is that net lending hasn't actually increased that much. So there is activity being stimulated within the market, but we've still got a long way to go, certainly in the mortgage market. In addition to that, we've got a general situation where base bank interest rates are at record lows. So you've got a situation where investors are trying to chase yield, but they're struggling to find places to put their money. So cash in the bank with current monetary policy is going backwards. You've got high inflation, and then sort of other investable asset classes like the stock market and so forth have been very volatile. The property market appears to be a good place to put money, but it's not really one that generates a great yield, depending on where you're investing, and there's high transaction costs and things like that. So what we did in terms of when we set up Montello, we originally were funding transactions on a deal-by-deal basis. So we set up the business, we essentially had no capital. So we were a shop front for borrowers to approach us and say, I'm looking for a loan. We'd do due diligence on it, and we had a couple of high net worth investors that would invest on a transaction by transaction basis. It was a great way for us to get a foothold in the market and a bit of a track record, but a hugely frustrating way to build any sort of any sort of scale or sort of build a brand and reputation as a lender, because there would often be a situation where perhaps the investor's on the beach in the south of France and he doesn't want to do the deal. So we had no automation with what we were doing. We were doing transactions by meeting with investors face to face, doing emails, phone calls and so forth. So it was a very sort of hands-on approach, and that was really what set us to go and set up our first fund. At the same time, we're coming to these London New Finance events and sort of watching the whole crowdfunding space. it became particularly interested in terms of what was happening. So we saw that there's a lot of buzz around the industry, the sort of the concept. You look at things like Kickstarter and the general sort of the technology behind it is certainly there. And three things really struck us as a lender, but from the investment side as well. So the returns from a lot of the crowdfunding platforms were not particularly great. For the yields that we're used to getting lending against London property, as opposed to lending someone on an unsecured basis, the risk profile is totally, different ends of the spectrum. So you've got a situation where some of these platforms were offering sort of relatively risky propositions, but a low return. So it's sort of the perfect recipe for not being a very good investment. And also the other thing is a lot of the crowdfunding platforms are coming from the perspective of a tech company. So they're generating the platform and the algorithms, and that's largely because they're focusing on unsecured lending. So the algorithms are relevant in terms of profiling a borrower, but they weren't coming from a great deal of lending experience. So we thought it was a great opportunity for us to essentially take our business online and in some respects take the business full circle. So we're going back to the situation where we're making loans available on a loan by loan basis to investors through a crowdfunding platform, which is LendInvest. So investors can go and buy parts of that loan or the whole loan. So in terms of LendInvest, our business and how it works, like I say, it's a peer-to-peer platform for mortgages. It's a fairly basic concept. Essentially two sides to it. The investors being matched with the borrowers. At the moment, we're targeting high net worth and sophisticated investors because we're trying to get as much scale as possible in as short a time frame as possible. So taking sort of £20 investments from an investor is not really our business, which is what a lot of the crowdfunding platforms are doing as well. So we're trying to get a bit more scale to it, and obviously bearing in mind that we're dealing with mortgages, so they're typically larger amounts of money than an unsecured loan. So we put our loans up on the platform. Investors can go on and they can sort of judge the sort of risk that they're prepared to take. They might like commercial property in the East End, and they're prepared to lend up to a certain loan to value, and for that loan they're prepared to take that return. So it creates a sort of market in the background to the loan book that we have. For borrowers, obviously there's two sides to that as well. So there's new originations where a borrower can approach the platform for a loan. They can say, this is my track record, this is the asset that I'm looking to buy, and this is the cash that I've got to contribute to the transaction. And then we've got the secondary market, and that's where we're actually getting most traction at the moment. Our platform's sort of at the initial stages of its evolution. So we're taking loans that we've completed through the Montello loan book, and we've put that up on the platform. So that's sort of a secondary market. It's attractive for investors because if they invest today, they can start earning interest straight away. So it's not a crowdfunding platform where a loan goes up and then it has to wait for sufficient bids to then go live, and then the investors start earning the return. In this instance, you can take that loan part and start earning straight away. In terms of why LendInvest, I think there's going to be a lot of players that will come into the whole sort of broad umbrella of crowdfunding. There's a lot of really great platforms out there. Like I've said, with Lending Club, there's Funding Circle in the UK focusing on SME lending. There's RateSetter and Zopa and a couple of sort of established players that are really starting to get scale. And these guys have lent over 100 million each of them and are starting to ramp up their volumes as well. I think for us, we're going to stick to our niche. So we are going to continue to be a secured peer-to-peer lender lending against mortgages. And actually, we're very happy with the returns that we're providing to investors. So whilst we're still only at sort of the 6.5 million in terms of what we've traded, we're providing investors with a net return of sort of 6 to 12%, and that's all with a first charge against property. So we think it's quite an attractive proposition. The other thing is, like I say, it's all secured, and the other thing is it's leveraging off our background as lenders. So sort of as an investor that comes onto the platform, they can leverage off our underwriting expertise and experience and so forth that we've got in place. One of the things that's critical as a lender is it's easy to lend money, particularly in this environment. In terms of it's very easy to find people that need money. The experience of being a lender is critical because it's making loans that come back. That's the hard part. So that ranges from a whole range of things, from like fraud detection systems. So one of the things we've got access to is CIRA. It's a very expensive system, but it's a comprehensive platform that most of the main financial institutions in the UK have access to, where it can cross-reference loan applications and so forth. So there's a whole range of systems like that that we've got in place. In terms of where we take the platform from here, there's a number of things we've got planned. One of the key things which I think will be quite transformative for the whole crowdfunding space in the UK is that the FCA is in the process of developing a regulatory regime. So loan trading platforms will need to be regulated next year. The anticipated timeframe for that is April. And we've been talking with the FCA. They're sort of aware of what we're doing. There's an open dialogue there. So certainly as soon as that regime has been formalised, we'll get regulated, which I think is a great thing for the industry. We're going to try and sort of open up our lending so it's not just secondary lending, sort of the secondary market. We'll focus a little bit more on new originations, and also sort of while we're keen to sort of get some exposure to a group like London New Finances, we're trying to build out a team. So we're looking for experienced people, primarily on the tech side. We've been able to build a lot of the platform with outsourcing our tech. That's not something that is going to allow us to scale it to the size we want to, so we're looking to build a team in-house and hire underwriters and so forth. And then the broader vision is to be able to integrate it more closely with our existing Montello investment products. So an investor might come to an integrated platform and say, well, I want to invest £100,000, and they can sort of pick 3 loans that they like the return on that are perhaps a little bit riskier, but take the higher return, and then they can get the blended return across a portfolio through one of the funds. So that concludes the formal part of my presentation. So if there's any questions, be happy to answer them.
Hi there, I'm Darius, and from Assets Capital.
Ah, yes.
I'll ask you some non-probing enemy questions.
Yeah, please.
So you mentioned about first charge securitization. So it's entirely bridging loans, is that correct?
It is at the moment, yeah. So it's, I mean, that's what our expertise is, and that's where the primary sort of deals that we're generating in terms of our, the Montello side. So we see between 50 and 100 million a month of loan applications coming our door. We've built a reputation as a short-term lender, and for us to have good lending, increasingly that is to have repeat borrowers. So that's sort of the market that we've developed a niche in. The expertise is very similar to doing term mortgages or sort of a slightly longer duration loan, but it's not where we've attracted the deal flow to date.
Okay.
Yeah.
And that's 6 to 12% return. How do you denote what risk levels that they're at?
So we've been talking to a number of different funds that are sort of looking to, quasi-institutional funds that want to raise money to invest on these platforms. And one of the things that seems to be coming out is that they don't necessarily like a true transparent auction process where it can be a race to the bottom for what they see as dumb money. So the guy who wants to put 50 quid on the platform is prepared to take a 1% return for a 100% LTV loan. You don't want everyone sort of rushing to the high risk and low return sort of space. So we try and just use our underwriting skills and sort of where we can price it sensibly to make sure we get the deal. I mean, for us, like I said, we always get a huge volume of loan inquiries. It's always a balancing act between ensuring that you get the right level of risk and then the right level of return for the capital that we've got to deploy. Yeah.
Okay, thank you.
Hi, my name's Jake from Grant Thornton. I've got 2 questions. How do you see the future of crowdfunding when interest rates do rise and that there isn't the attraction of saying we can't get these returns elsewhere? And the second question is a challenge that we've seen from the banks is saying that when interest rates do rise and there is this disintermediation, banks obviously have the infrastructure and the relationships to be able to sort of manage defaults. So how do you think both LendInvest and the industry react when those defaults maybe start?
Yeah, it's interesting. I was at a conference this morning, which is a peer-to-peer thing, and there were a couple of the larger players there on the sort of unsecured lending side, and the institutional type investors were asking those questions. It's a great concept now, and there's all these sorts of reasons why crowdfunding is a hugely popular thing, but interest rates are not going to remain at 0.5% forever. And obviously, as Well, there's two sides to that. So as the economy gets better and interest rates go up, then arguably defaults may be less of a problem. For us, I think we're positioned really well for that because we're secured lenders, and that's why I think you've always got recourse against the asset. In terms of the manpower to enforce defaults and to manage that process, that is an expertise thing, but I don't think the banks are best placed to say they're the only ones that know how to do it. So it's it's obviously going to be an interesting space to watch over the years. I think there is that anti-bank sentiment, so I think the banks have burnt a lot of people on the investor side and the borrower side. So one of the large SME players in the UK on the crowdfunding side, we know relatively well, and they sort of say that they're developing really good relationships with their borrowers, which comes back to the point of sort of repeat borrowers. So once someone's gone to that crowdfunding platform, they've successfully funded their business to whatever level they're at, they've paid that loan back, and perhaps they want to buy additional plant and equipment or whatever it may be, they're probably more likely to go back to that platform than go back to Lloyd's that called in their, or whatever the bank is, that called in their overdraft when things got a little bit tough. So yeah, we'll see.
Hi, my name's Alex. I'm from Covesta. A couple of quick questions. Firstly, what's the typical term of your loans? And secondly, how liquid is the secondary market?
The term, our average duration across all of our lending activities, so the 70 million or so, average duration is about 6 months. So it's quite short term, relatively liquid. In terms of the secondary market, there hasn't really been one until we had the LendInvest platform. So that for us is just a work in progress in terms of getting enough exposure and building investor trust. It's sort of a double-edged sword. We're going for the sophisticated and high net worth investors to try and get scale. But at the same time, those sorts of investors typically have more difficult questions and probably take a little bit longer to gain their trust than someone who's punting 20 quid on a platform. So it's a work in progress, and hopefully we can sort of ramp that up as time goes on.
Cool, thanks.
Hi, Rafael Gomez from Accenture. One of the reasons why banks are widely mistrusted now is that they engaged in a lot of irresponsible lending, so giving out mortgages to people who couldn't afford them, essentially. Are you more conservative than the banks in that respect?
Well, it depends on what you call conservative. I mean, our maximum loan to value is 75%. So there's banks in the market that are lending higher than that now. So we're more conservative in that perspective. It's a different approach. So it's not tick box lending, and it's not necessarily with our platform in its current form. But there's certainly the broad concept of crowdfunding allows it to be put to the market. So what you may perceive as being a high-risk loan, I might not think, or the other way around, and it's a matter of what sort of return you expect to assume that risk. Yeah, I mean, I think, I don't know if there's that many banks. I mean, obviously, we'd be small if we were a bank, but there's not many banks that haven't lost any money in 5 years of lending, so.
I was thinking also from the borrower's perspective, I suppose.
In terms of whether we're more aggressive?
Yeah, in allowing someone to borrow through your platform.
Yeah, I mean, we can be, and that's where, so if we can get critical mass on the investor side through the platform, there is the potential for that. A good example we recently had, someone came to us, they needed 100 grand, or they wanted 100 grand. They owned an unencumbered flat that was worth 500,000. It was in a ex-council flat. So banks pretty much across the country, if it's an ex-council flat, they're not keen on lending. And they've got this arbitrary rule, if it's above the 5th floor, they won't lend. So, so this flat was on the 7th floor, it's unencumbered, it's 100 grand. I mean, so obviously nearly every lender in the country perceives that as high risk. Now that goes to the age of the building or some sort of, it's arbitrary, it's tick box lending. So, yeah, we're happy to do that sort of transaction. It was in London, and the borrower subsequently paid that back. So, in terms of I don't know why the banks think that's high risk, but that was a good example where you're effectively creating a market. So if an investor is happy to assume that risk, whatever that may be, there's obviously other circumstances surrounding it, but yeah, that sort of was a good example.
Christian, thank you very much. Thank you indeed.
Thank you.